Joining us now, first on CNBC, Coca-Cola CEO, incoming Chairman James Quincey from the company's headquarters in Atlanta. Good morning, James.
Morning, Sarah.
I was going to start on the quarter, but I think we have to start on this stock move. It's down almost 7%, worst day for Coke in a decade. Are you surprised to see the reaction to the outlook?
I think the reaction started to embed in some of the headwinds that they're facing in 2019. I mean, in the end, we had a great result in 2018, a strong operational performance. We got a strong plan for 2019, good top line growth, good margin expansion. Yet we face headwinds on the forex and on interest and tax. We're trying to be prudent in our outlook given the volatility and the uncertainty for the year. But what we're focused on is continuing to drive our strategy, which is producing results. And we'll have to manage all the levers going through the year so we can turn that into the best possible results for the shareholders.
So I just want to be clear on this because there's some discussion in the analyst notes. The weaker outlook, and I think weaker organic revenue than some were expecting as well, is it all tied to macroeconomic weakness and strong dollar?
Yeah, well, the organic revenue growth is not particularly related to the dollar. That's the translation of the earnings. But the headline number is slightly softer than 2018 with 4% organic revenue growth. That we think will still be at the high end of consumer products organic revenue guidance for 2019. And it does represent perhaps a more prudent view on the macroeconomic growth available in 2019, which is going to be a little softer than 18. So it's still a strong number, although a little less than 18, but we'll be focused on executing our plan and really driving for the best number we can go for.
So where in the world are you seeing weakness when it comes to the outlook this year?
As we look into 2019, clearly we see softness in some of the countries that stumbled a little towards the end of 2018. Argentina went down strongly at the back end of last year. Turkey's now adjusting to some of their macroeconomic troubles, some of the other countries in the Middle East. And of course, Europe has softened a little bit coming into 2019. So I think it's not one country in particular. There's, I think, a few parts of the world that are softening. They're clearly represented in the IMF economic outlooks. But again, you know, the good years and the bad years will come. What we're focused on is really executing against that plan. We've got good brands, good marketing, good innovation, and our bottling system is executing.
We just got a very ugly retail sales report for the month of December, and we're trying to figure out if it was seasonal, if there were one-time factors like the stock market decline and the shutdown, or if this really suggests that the U.S. consumer is weakening in a meaningful way. What are you seeing?
Well, we saw in the fourth quarter a slightly softer demand outlook in the U.S. I think part of that was our industry, the beverage industry, as the price increases from the summer fed their way through fully to the consumer. But it was a little softer in the fourth quarter. But I think what we're encouraged by going into 2019 is we see a little bit of it coming back in terms of the growth, both slightly growing in the U.S. and then growing globally, such that we see volume and price mix at the start of 2019. It may be that the back end of the fourth quarter was a little softer than the first quarter will end up being. But we want to be prudent in our guidance for the outlook and focus on what we can execute against and really manage our way through 2019, which I think in the end will be more volatile and uncertain than 2018.
You think the U.S. corporate and individual tax cuts are still helping consumer spending and the overall economy here?
I think there is consumer spending still. I mean, clearly there's some adjustments going on. Sentiment tends to be a little more volatile than perhaps has been in the past. But we see resilience in the consumer outlook, and we see resilience with our customers in terms of their plans to drive growth in the business.
As far as the portfolio, I mean, you continue to see this double-digit growth in Coke Zero Sugar. What else is working right now, and what's not working?
Well, the things that are working, I mean, the sparkling business worldwide grew in revenue, grew in volume, helped a lot by Coke Zero Sugar. It had its best year ever last year. The stabilization of Diet Coke in the US, so some really strong growth in sparkling, some strong growth in the premium segments around the world, whether that be the premium juices, premium waters, taking control of ready-to-drink tea finally around the world. The places where we've seen some softness are places where we've chosen to put less emphasis on some of the very low-priced water and juice drinks around the world. So we're happy with the focus of our portfolio. It's expanding, we've got innovation, and we're driving growth.
Question on China. You've told me before a few times, James, that you're not really feeling an effect of the U.S.-China trade fight when it comes to consumer spending in China. Is that still the case?
Yeah, I mean, we're such a local business because all the drinks we sell, generally speaking, 95% of them are made in the country that we sell them in. So the China-US negotiations on trade don't directly flow through to us. It's more the general sentiment. I think we saw China, a bit like the US, a little softer in the fourth quarter. But the beginning of this year, the Chinese New Year has been very strong for us so far. It's only early days in the year, but we see demand there at the beginning of the year in 19 in China and in the US.
Just curious, I mean, the news is that President Trump is inching very close to making a deal with China. As a CEO who operates there and so globally, would you be in favor of just seeing a deal and an end to the fight, or would you be in favor of holding out for a better deal that tackles some of the structural issues like intellectual property theft?
Look, I mean, of all the trade deals around the world, there are none that are perfect. All can be improved. And so our take on the world is, look, we think trade deals help global growth. We think they help growth in each of the countries that participates in a trade deal, and they can all be improved. So if there's an ability to improve the trade relationship between the US and China, I think that would be a positive thing.
Wanted to talk to you, back to products, about the flavors. Vanilla orange is the new one you guys are touting, first change to brand Coke in years. The Diet rolling out some new flavors. What's driving this trend? Who's driving this trend, and what are you seeing?
I think around the world you're seeing consumers more interested in personalization, more interested in trying new flavors of brands they love. And so you see that in the US with new flavors on Coke, new flavors on Diet Coke. Clearly it's been part of helping stabilize the Diet Coke business, along with packaging and some great marketing. So I think you'll see more from us in terms of innovation, not just around new brands and new products, but also on new flavors. And of course, the other part of the equation, which is perhaps not so sexy, pulling out those ones that aren't working so well and really helping the innovation machine be engaging for consumers. Tends to be more millennials and young adults, but everyone's interested in them.
James, it's Mike Santoli. I wonder if you could weigh in a bit on your thoughts on capital allocation, sharing cash with shareholders. As you know, there's been a lot of critical attention on corporate stock buybacks lately. Now, you're in a pretty unique position, a mature company, lots of cash flow, but you really utilize most of it in terms of sharing it with investors in the way of dividends. You do buy back some stock, but only about a third as much last year as you distributed in dividends. How do you think about these issues, the use of cash, and whether, in fact, it balances out with investment in the business?
Yeah, sure. Look, our starting point is doing the right things to invest in the business for the long-term growth. And we've been clear that we would prioritize our dividend and the growth of the dividend over share buybacks. We've moved to a position where we're just buying enough shares to avoid dilution by our employee stock programs. And that's a position we've taken. But as I say, our number one focus is using the cash to drive our business organically, returning dividends to the shareholders, and then occasionally making some M&A plays with a less of an emphasis on share buybacks. And that's working for us, and that's the approach we're going to take for the coming years.